Hello, everybody. Good evening. Um, this is Pastor Burckson. I'm welcoming you to Kingdom Expression Business School. Welcome, welcome, welcome. I trust you had a good time in church. The Word of God came to you. You were blessed, encouraged, and strengthened. This evening, for the time we have, we want to have a conversation on practical ways of financing your business in Ghana. We started this last week, and we want to continue this week and see how far we can get into this conversation. So please go ahead and share the link. Let me kindly ask you to do this. Share the link, invite friends, business partners, associates, especially people who are called into business, talking to believers. We're trusting God to raise men and women who have a calling into business, to also set up corporate citizens, businesses and companies that have the DNA of the kingdom, that will become vehicles for propagating and advancing the supreme will of God on the earth. So this is a very organized and structured intervention to support every child of God who knows for sure that he has a calling into business. We're bringing material, insight, understanding your way to help you realize that calling. We're providing that support, technical support, to help you realize that calling and become effective in managing a sphere for God. So let's go ahead and invite friends, invite, loved ones, and let's have this conversation that I trust will be enlightening and beneficial to you. So please go ahead and let's do this, giving ourselves a few minutes to do this, and then we can get into the material we have for today. Thank you for connecting. So let's give ourselves a minute or two to connect, to get on board. All right. So by way of recap, last week we looked at the main streams one can tap into to finance their business, and we said that the primary way to do this is to put your own money in your business, and we call that equity. But equity can either come from you, or equity could come from other sources, people or institutions or investment vehicles who are interested in your business venture and would want to own or share the risk with you and own a part of the business, and then they could also put up some money, some capital to finance the operations of the company or of your business. So the equity can come from you or from other people who want to be a part. They want to own part of the business. If you have that, we mentioned last week that sometimes you may get a partner or an institution or an investment vehicle that will want to be a part of your business or share, the ownership with you, but for a period. And so they could tell you, okay, I'm bringing this money as equity for a certain period, could be 5 years, 7 years, whatever is agreed on, and then at the end of the period, you will convert that equity to debt. You pay them off, and then you take delivery of the shares they owned whilst they had invested as equity partners. And so that possibility exists. It exists. And then we also talked about using debt to finance your business. And using debt to finance your business, we zeroed in, because debt can come from all kinds of places, but we zeroed in on securing or procuring debt from banks and financial institutions. And so we really took time out to look at the posturing or orientation of banks. And in order to make this broadcast relevant to you, we actually contextualized what we're talking about and restricted it to our experience in the Ghanaian context. And so we're really looking at Ghanaian banks and how you can access debt finance from Ghanaian banks and Ghanaian financial institutions. And we saw quite clearly that many of the banks or financial institutions have a certain orientation or posturing. And if you don't understand how they think and how they view your business, you will be frustrated. You will have a lot of issues with them. And so this broadcast and this intervention is to help you understand the thinking, the general thinking, so that you will also know how to proceed when you're dealing with them. So we said that banks will normally lend you money when you do not need it. And we said that there are two factors that give rise to this phenomenon. One will be that by the time the money comes, because of sometimes the bureaucracy of whatever transpires, by the time you need the money and the time the money is available for use, you probably would have missed the window of opportunity you were sourcing the funding to go and execute. So we said it has been the experience in this context, the Ghanaian context, that many times, I'm not saying that's the only thing that happens, but many times, by the time the money is available for use, you don't need it because the opportunity is gone. So there is a timing gap, a lapse, a timing lapse that makes it, sometimes very difficult, if not frustrating, sourcing for debt finance from banks and financial institutions. And we said the other leg about banks lending money to companies who don't need it manifests itself in banks sitting and knocking on doors of companies who are very liquid, because the thinking is that if the person is liquid and you're able to convince him or convince the business, or convince the directors, or owners, CEOs, to open up for debt financing in their business. The thinking is that they will not default because they are very liquid. They are doing a lot of things for cash, and if they are doing a lot of things by paying cash, then if you convince them to come for a debt finance and try to sell some of the benefits of that, you probably will get them to say, okay, let's put the money to use in some other way, or let's let's lock our cash in some liquid investment and then go for a facility. I mean, you can sell that debt to a very liquid company. And so you as a business person, a startup who is really determined to source some funding to finance your operations, because you come across as desperate, you really need the bank. They usually don't want to deal with you because you come across as someone who will default, because there's this tone of desperation in your voice and your outlook, the way you are carrying yourself. And so we also mentioned that you need to really understand that posturing from the banks if you're dealing with them. And then we said banks chase businesses that don't need money, and that's a fact. What we ended on last week was that the banks are very much interested in project finance business cases. A business case that is structured as a project finance. They are usually very excited about things like that because many of those projects have secure and verifiable cash flows backing them. And once a bank hears that, these are the expected cash flows, it's secure, the paymaster is solid, off-taker is solid, paymaster is solid, this is the secure cash flows, they are very excited, they want to listen to you. So there is a certain bias, there is a certain slant our banks have when they are dealing with businesses. They are looking out for business cases and proposals that have an underlying cash flow. So whatever service you are rendering or product you are selling, they want an off-taker or a paymaster, and they want to see a certain commitment in terms of how much cash is coming in every month, and then they want to know how long this relationship will be for, and they are really willing to jump in and finance you. So if you understand that this is the appetite of the banks, literally, or the financial institutions in Ghana, then to begin with, you could also open up and structure some of your transactions along the lines. So what that means is that you are trying to speak the language of the bank. You see, you're putting yourself in shape so the banks can understand you. You want to speak their language. You want to be able to communicate with them. What that means is that if the bank is expecting your business case to have an underlying cash flow and have an off-taker or a paymaster, who is creditable, who is reputable, who is a blue chip company or very solid, and have the tenor being within the term of the facility you are looking for. If you're able to satisfy all these things, you make your case very appetizing for the banks. Okay, and when you know this, then you can speak that language, because that's the language they understand. I'm not saying that's the only finance language there is, but unfortunately many of the banks in our space have a certain slant. But they can also explain to you, they can tell you that the source of their funding also has some inhibitions, and so they can't also be that open in terms of the risk they are willing to take in financing businesses. Okay, so That's one thing we mentioned, that the banks particularly are interested in project financing, which usually is cash flow backed financing. They really like that. The other thing we can see with the banks in our environment too is they are heavily obsessed with collateral. I mean, collateral is such an interesting phenomenon for banks and financial institutions, and yet many of them will tell you that, you know, the collateral is just a fallback mechanism, that should something go wrong with the transaction, they will fall back on the collateral, and so they are happy, you know, if you have collateral. Okay, it is so popular in the banking space that you can have transactions that are structured as leases, and the beauty of a lease is that the asset you are financing becomes the security for the finance or the transaction. And yet, because banks are overly obsessed with collateral, you can have leases that have collaterals. It's interesting, isn't it? The beauty of a lease is that the transaction you are financing, or the equipment you are financing, secures the transaction. So, for example, we're buying you a plant, or we're buying you an earth moving equipment. Okay, so here you are, earth moving equipment, we finance it. The whole philosophy and thinking around leases is that productive equipment you have bought becomes the security or collateral or backing for the financing. And yet you can find a bank in Ghana who will buy you, okay, finance an earth moving equipment and still be requesting for you to bring an immovable property as a collateral. So they have financed an asset which is a collateral for the transaction, and they are still asking for another collateral. I mean, these are some of the miracles that happen in our banking space, where collaterals have collaterals. Isn't it amazing? And you need to understand this, because this is the language they speak. And so if you will be overly frustrated, especially as a startup or upcoming business or an SME, when you are confronted with such realities on the ground, especially if you don't understand it. But if you do, you probably will also be able to make a case and say, oh, but I thought the equipment you are financing will be the security for the whole transaction. Why am I being asked to bring a landed property, you know, and all that? Sometimes we lose the beauty of the financing because we are, you know, so fixated on the safety, the risk, and all that of the transaction. I'm not saying that doesn't exist, but I think there are more innovative and creative ways of looking at this. We mentioned that many of the banks, many of the financial institutions in this space, they just lend you the money and go to sleep hoping for you to come and pay. You know, they are not working closely with you. And I mentioned that the banks are full of professionals, and you know, they could actually put them to use by helping the businesses. Then it really becomes a form of a partnership, you know, a partnership where they are providing the money, but because they also have a gamut of technical people, professionals sitting in their spaces, they could find creative ways of really giving you the technical support you need, just so that your business will do well, and then you will be able to repay whatever facility you have gone for. You know, so you need to also understand that the banks in this area, or in this context, in this space in Ghana, you know, extremely excited about collaterals. Extremely excited about collaterals. If you want money from the bank, then you can focus on this, and I probably will end on this. If you want money from the bank, as it is, the bank as it is, if you want money from the bank, you need to ensure that whatever business case you are presenting for financing will have a firm contract on it. Okay, so whatever service you are providing, whatever goods you are selling, whatever products you are selling, a bank is not excited in you coming and saying you have a product or you have a service. They should give you money so you use your best efforts to go and sell it and come and repay. No bank will do that. No bank will do that. Usually what they will ask for is for you to have a firm contract. And the firm contract must be between you, the person who is intending to deliver the service or the product, and then an off-taker or a paymaster who is credible, reputable, who is very solid, who is both able and willing to repay the whenever you deliver or supply the services or the products. Okay, so you need to have this in mind. You want to approach a bank to get financing until their posturing change, until the current posturing of banks change, as they are now. The language they will understand is for you to approach them with a firm contract. And I'm saying that firm contract must have a negotiated tenor that is not less than the term of the facility you're looking for. So for example, if you want the bank to finance your business, okay, and you need that money for 3 years, you can't go to the bank if you want them to quickly move with you. You need to go to the bank with a contract that is asking you to supply service or product that has a contract period of not less than 3 years. If you want the facility for 3 years, you need to match the term of the facility with the term of the contract. That excites them. That excites them. What you could also do under such a circumstance, assuming you have history behind you, for example, you have really supplied or provided some service to a certain off-taker or paymaster, and you've done that for a while, and you want a facility from the bank. There are instances I have personally seen and experienced where even though you have a 1-year contract, because of the abundant evidence that the risk of it not being renewed has been taken care of, other sources of income should this contract be terminated is in place, and other gamut of interventions are around that particular structure, you are able to secure a facility for say 2-3 years, even though you have a contract term of 1 year renewable. Okay, so that possibility exists, but usually as a startup or as a very small business that doesn't have other sources of income or other clients that can become a buffer for that main contract that you're using to raise the funding or financing, many banks will not look in your direction. If you have a 1-year contract and you're asking them for a 3-year or a 4-year or a 5-year facility, many banks won't do it. Very few. And even that, if there is the absence of abundant evidence that the other sources that brings cash into the business that can repay, and even that they will also want to be sure that that source is also secure. And you need to understand the thinking of the bank. The thinking of the bank is that the contract must be firm, the tenor must be in place, because they don't want to take the short end of the stick. They want to be sure that the cash flows from the contract will be able to support the repayment. Okay, so usually what you will find is once you present the contract to the bank, they will quickly check how much are you going to get a month, looking at the rate per whatever service or product you are supplying. And once they're able to establish how much you are going to generate a month, they want to just satisfy themselves that your monthly repayment or quarterly repayment, depending on the frequency of payments, some banks may not even be flexible enough, assuming you are receiving quarterly repayments. Some may not be flexible enough to do a quarterly repayment for you, because the whole essence of this is for the repayment to tie in to when you are expecting cash. But you can have a lot of issues along those lines. But once what you are generating a month is able to cover the repayment, they will be interested. Plus, there should be also enough for you to maintain whatever equipment or direct inputs that you have, which will help you deliver the contract. Okay, so it's not just being able to generate enough to do the repayment. They need to be sure that whatever is left will be able to do the critical things that will keep the contract going. That's also part of the performance risk. Okay, in assessing the performance risk, they want to be sure whether you will be able to deliver the contract. If you are able to deliver the contract, then they will be interested in talking to you. So I've talked about they focusing on a firm contract. I've talked about they being interested in the tenure of the contract, how that the tenure of the contract must tie up with the term of the facility, and how that they want to know in terms of the rate, how much you are able to generate from the contract, which is the main source of repayment for the facility. And then they also want to be sure that you have covered the performance risk. Are you able to deliver? Are you able to deliver? All things being equal, are you able to deliver? And I mentioned last week that one of the ways you can do that is to find a way of covering that performance risk. And I'm saying you can actually take a performance bond from an insurance company to assure the bank that that performance risk is covered. But there are many other things you could do to make your case strong, okay? Because it's on the strength of that business case that they are going to make a credit decision. So there are a lot of things you can throw into these ingredients, these elements that must be present for you to be able to get, some hearing from the bank. There are a lot more things we can also talk about in dealing with the banks. You need to really understand how they are thinking so that you'll be able to position yourself properly to deal with them. Our banks are not particularly excited about startups. And so if you are a startup, it becomes very challenging to secure funding or financing from the bank to fund your business. Okay, and so if you want to do that as a startup, then what I just said must be something you are really giving thought to. That is, you are a startup, but is it possible for you to secure a contract to provide goods or services? Is the contract term equal to the term of the facility you're looking for? Is your paymaster or your off-taker a reputable company? Are you generating enough from the contract to be able to service the debt? And then, have you covered the performance risk? What is the assurance that you will be able to deliver the contract? What is the assurance that you'll be able to execute the contract? You need to demonstrate that. And all these things I'm talking about, the bank is looking for demonstrable evidence. It's not just what you are telling them. They want you to demonstrate that. And so you point things out to them and show them what it is you've been able to do in the past, or how you have creatively come up with interventions that can assure or secure either the cash flow or your ability to deliver the contract, or any of the other ingredients in the equation. It's so important. So you are financing your business either through equity or debt. And the last we'll be talking about as I wrap up is your customers. Your customers are also, for me, the most sustainable way of financing your business is your customers. So limitless money to fund your business is with your customers. Okay, so I think you really need to give a lot more attention, to your customers. Generating, finding, maintaining, sustaining, growing your customers. That's where the bulk and more sustainable, stream of flows are to finance your business. Your customers are more or less your partners in business, really, if you look at it. Okay, but look at how we treat customers in this country. Customers are treated as like burdens. You walk into somebody's shop to buy, and it's as if you've interrupted, a very important thing. Then why are you in the shop? What are you trying to do? Are you not here to sell to customers? A customer comes, whether potential or actual comes, and it's as if it's a border. The person came to interrupt something important you were doing. But who is more important? Okay? You are in that business to sell to customers. A customer has come to give you his or her money in exchange for a value he or she perceives your product or service is delivering. You have to have all eyes on them and serve and ensure that they are satisfied. But many people treat their customers as a bother. And that is what you don't want to do. You want to ensure that you are satisfying your customers, because long term they are the most sustainable form or stream for financing your business. So limitless money to fund your business is with your customers. Okay? And the best way to get it is to exchange outrageous value for it. So limitless money is with your customers to fund your business. But the way to get that money from your customers is to exchange it. Okay? You get money from them and then you give them outrageous value. Give them more than they are paying for. And that's a big, we have such a huge deficit in our context. Customer service is almost non-existent. You know why? Because the companies that give those lousy customer service can get away with it. That's why it's non-existent. If they couldn't, they wouldn't. They are because they can. What are the options you have? It's as if all the competitors have come together, so they have joined a monopoly. And so if you're not happy with a service with A, and you are switching to B, you are just switching to a bigger problem. So there seem to be a collision between competitors to just fleece customers. Okay? And so in a context like that, if you become extremely passionate about ensuring that your customers are getting more value than they are paying for, I'm telling you, you will stand out. If you make it your personal responsibility as the owner of the business to ensure that whoever does business with you is taking more home than they are giving you, I'm telling you, you will have discovered a more sustainable way of funding or financing your business. So please, the best way to get the monies that will fund your business from your customers is to give them outrageous value, so they can give you money in exchange for that value. It's so important. And then finally, when you perceive value is greater than price, there is always a buying decision. Okay, that's why I said I'm just trying to help you see it from another perspective. Whenever a customer perceives that the value they are getting from your service or your product is more than the price they are paying, they make a buying decision. Okay, so if you really want to fund your business from your customers, if you want to make your customers your financiers, then just make sure that you are delivering more value than they are paying for. And if you can personally supervise this and make this your personal responsibility, you know what will happen? You are going to have a pool of customers, ever growing, ever satisfied, ever happy. I'm talking about a pool of customers who will be running over themselves to literally do business with you. It's so important. And I'm telling you, that is more secure than knocking on the doors of banks and financial institutions. If you can develop your customer base and keep them happy by giving them more value than they are paying for, you have found a sustainable way of financing your business. So please don't take customer service, customer care for granted. It's so important. These are the people who can finance your business long term. Don't joke with them. Don't treat them like they are a burden. Don't treat them like they are troubling you. Don't treat them like they are an interruption into something that is more important. No. You are in business to serve them. You are in business to provide something that they are going to give you money for. And so you want to make sure that they are happy. Thank you very much for connecting with us.